Hi everyone, welcome back to another exclusive podcast from IronFX, where we're dedicated to bringing you the absolute best education to help you take your trading to the next level. In today's podcast, we'll be talking about US equity indices, delving into the fascinating realm of major US stock market indices like the S&P 500, Dow Jones Industrial Average, and the Nasdaq Composite. We also explore the reason behind the rise of stock market indices, what factors could have contributed to their all-time highs, and whether they might be overstretched. Right. Let's start by understanding the main components of the major U.S. stock market indices, beginning with the S&P 500. Right. So generally, these indices consist of a diverse array of companies representing various sectors of the economy. Now, for instance, for the S&P 500, it includes 500 large cap stocks from different industries, while the Dow comprises of 30 blue chip companies and the Nasdaq is heavily weighted towards technology and growth oriented firms. Looking at the S&P 500, this index is often referred to as the benchmark for the US stock market and tracks the performance of 500 large cap companies as stated in its name, right? It provides investors with a snapshot of the overall health of the US equity market. Up next, we have the Dow Jones Industrial Average, commonly known as the Dow. Contrary to the S&P 500, which is market cap weighted, the Dow is price weighted and consists of 30 large blue chip companies as mentioned previously, right? So it's one of the oldest and most widely stock market indices, representing a diverse range of industries in the US, right? So as a joke, right, sometimes this index is also referred to as the Boomer Index. Just a little tongue in cheek over there. And lastly, of course, we have the Nasdaq, right, which comprises of more than 2,500 stocks listed on the exchange. And of course, as we all know, this is heavily weighted towards technology and growth-oriented firms, right, making it a very popular index for investors in the tech sector. Now, let's explore why these indices are important for investors. Beyond serving as benchmarks for market performance, they also play a crucial role in asset allocation, portfolio diversification, and risk management. Right. Investors and traders often use these indices as reference points to gauge the performance of their investment portfolios and track the broader market trends as well. But what factors influence the movement of these indices? There are quite a few, right? There's aspects such as economic indicators, corporate earnings reports, geopolitical events, and of course monetary policy decisions as well. All of the above have the potential to impact stock market indices, right? This could be negative impact as well as positive impact. Additionally, investor sentiment, market speculation, and trends in specific sectors can also contribute to fluctuations in the values of the indices. Additionally, accommodative monetary policies such as low interest rate and quantitative easing measures implemented by central banks can also provide ample liquidity and support for equity markets. Now, we have seen this uh, in 2020, right? Immediately following the pandemic lockdowns, the global pandemic lockdowns, we had ample liquidity measures provided by central banks around the world, and also back in 2009 as well. Right, in 2008, for those who may remember, we had the Lehman crisis, and following which we had a huge market correction as well, when basically we had a big global financial crisis. And coming out of that crisis, central banks uh, dropped interest rates very low and also started quantitative easing measures as well. So such accommodative monetary policies also help to inject ample liquidity and create a lot of support for equity markets. Now, on to the intriguing question. Why are these indices reaching all-time highs? So several factors could be at play, right? Firstly, we do have strong corporate earnings throughout 2022, right? Especially towards the end of 2022, we had strong corporate earnings that have been a driving force behind the recent surge in indices, right? When companies report robust financial performance and earnings growth, right, this often attracts investor optimism and contributes to the upward momentum in the stock. So not only is it going to attract investors, but also short-term traders as well. There are many traders who will be looking to play the earnings season as well, perhaps taking up positions just prior to a particular stock that they have been tracking, anticipating that they are going to beat its earnings estimates, right? This could be the top line revenue as well as the earnings per share or EPS metric. However, amidst the euphoria of record breaking highs, the question now arises: are indices overstretched? While the current rally may be justified by strong economic fundamentals and corporate profitability, especially in the US, right, we are seeing very strong and robust economic growth over the last few quarters. However, there are concerns about potential market exuberance and stretched valuations. Even now, some analysts warn of a disconnect between stock prices and underlying economic realities, raising a couple of red flags for investors and traders, right? Especially with inflation in the US seemingly being stubbornly sticky, right? It is not retreating as quickly as it has throughout 2022. This could now create some problems for the Federal Reserve, right? So what is the current verdict? While indices have indeed reached unprecedented levels, whether they're overstretched depends on various factors, including earnings sustainability, market sentiment, and of course macroeconomic conditions. Right? Investors and traders should always exercise prudence, conduct thorough research, and maintain a diversified portfolio to navigate potential market volatility as well. Right, and also when it comes to trading as well, we always don't need to have a position on hand. Right, sometimes being flat is a position as well, and it could be a very good position to take every now and then. Right, so that wraps up today's episode of US equity indices, where we've explored the significance of major US equity indices like the S&P 500, the Dow Jones Industrial Average, and the Nasdaq Composite. Before we end, do remember to subscribe to our podcast here at IronFX, where we are dedicated to bringing you the very best education to take your trading to the next level. Until then, happy investing.